Welcome to the Xceptional Insights podcast. I'm Sean Wargo, and I'm joined by my colleague, Peter Hansen.
Hello.
Together, we make up the market intelligence team here at Avixa,
where it's our job to identify trends in the economy and understand how they affect our industry, the professional audiovisual industry.
Hello, this is Sean Wargo and Peter Hansen back for Xceptional Insights, our podcast. We're here to talk this time about the 2024 outlook. Lots of new data coming in, lots of mixed perspectives, so we wanted to give you a sense for where the data is really pointing to today. I think, as always, Peter, we would start with macroeconomics. What are we hearing? What's the general sentiment, perspective as we look at 2024 and beyond?
Yeah, mixed news. The news for late 2023, which is kind of coming out in the last month or so, has had a few more negative notes than we would have liked. So recession in Germany seems like a pretty nailed on result. Back-to-back quarters of GDP decline, but also just general decrease, weakness economically. UK also looking like potential recession. There's back-to-back quarters of GDP decline in the second half of 2023 there, although it's less obvious that that's a recession because there is other positivity in the economy. Wages are growing. Employment is strong there. So a lot of people do talk about that back-to-back quarters as a quote-unquote definition of recession. Economic consensus is that it's not sufficient. A great example is the U.S. had back-to-back quarters of economic contraction in 2022. That was a great economic year for the U.S. We added millions of jobs in that back-to-back quarters. It was more of like a technical shift in GDP, kind of as the economy transitioned then. So back-to-back quarters of decline is not enough to make a recession. But in Germany and the UK, there is that kind of broad-based weakness, especially in Germany. Though, the question is, of course, where is it moving going forward? But before kind of put the bow on UK, Germany late last year, want to mention that all of Europe kind of faces that weak economy. Now, the context is we thought there was going to be a recession in Europe in 2023. So to see only two countries only in the second half, and even one that kind of maybe on the border of having a recession, it really is a good news compared to what we expected.
Right.
That said, not great news, not as good as we maybe would have hoped after we started to get good news early in 2023. Now, moving into 2024, the news is more good. UK already, numbers came out for January. They do some month-to-month GDP measuring, seeing growth. Down year to year compared to January of 2023. January 2024 compared to the previous year, but January 2024 up from December 2023. So there's some good news kind of on the back onto the upward trajectory. The rest of Europe, there's weakness there. There are challenges, but still on a kind of a slow upward trajectory. Now, Germany continues to have some structural issues. They have this economy that's relying on manufacturing and on exports, kind of a close trading relationship with China. And that's not the strongest place to be economically right now, because moving kind of the spotlight from Europe to Asia Pacific, China's facing a bunch of its own structural problem. It could be its own podcast, really. Talking about actually doing maybe a meta deep dive on Asia Pacific, kind of the economic outlook there, because China's been the engine of GDP growth globally, pro-AV growth specifically for our industry, and it's going to have challenges to continue to be that through the 2024, through the forecast period. It certainly looks like it's slowing down, but there's a lot of positivity in the rest of Asia Pac. We've seen upward revisions recently, kind of in outlooks for India, another big economy there. Possibilities that India is going to be third biggest economy in the world, kind of in the not immediate future, but sort of like foreseeable forecast trajectory, drawing lines based on population, economics, education, et cetera. And then there's a number of kind of medium large, somewhat compelling countries there. Indonesia as an example of kind of a bigger, sneaky large economy that has its own strong growth. So just a few places to keep your eye on there. I would say not surprising to see Asia Pacific still kind of the leader in growth, even if China's starting to disappoint a little bit. There's just enough elsewhere, enough strength. Last place, let's talk about the Americas. Kind of a mixed bag. South America, Central America continuing to have really a lot of kind of political transition challenges. North America, well, we saw great GDP growth in the U.S. especially last year. That was probably the big positive surprise of 2023. 2024, we're looking at more moderate growth. But hey, moderate growth is a great platform for our industry to be building on. There's so much that our industry is sort of developing now as we exit the pandemic, bringing in AI. There's so many ways for our industry to continue to do more for the economy, kind of to soak up more of that GDP pie. So as long as you're not having a meaningful recession where money's too tight for a new spend on any type of technology, including AV. As long as you're having that some level of moderate growth, I think that's a great platform for our industry to build on.
So let's talk about interest rates. So one of the questions, as we look at some of the data coming in and the perspective that's out there, there's this question in the marketplace, well, have interest rates been high enough, long enough that we're starting to see that impact even corporate outlook, what their plans to spend, their intent to spend, that kind of stuff. We do have the Q2 data for more, in fact, is showing a little bit of softness as we go into the quarter, lower than we saw in Q1, which suggests maybe there's companies hedging their bets a little bit. What are you seeing? Is that a factor for us at this point?
Yeah.
Interest rate declines are probably still a little ways out from what we're hearing from feds around the world. But
yeah, that's a great question. We are really in a new era compared to almost the last couple of decades in terms of interest rates. Inflation pushed central banks around the world to drive their core rates up. And we are now in what the 80s would tell you is a low interest rate environment, but the 2010s would tell you is a very high interest rate environment. Right. And businesses have been planning in that 2010s mindset for a long time. And so now the current interest rates really around the world, so many central banks kind of driving interest rates up. That's been a change for the economy. A couple of points on it. So one, the interest rates are being driven up in response to inflation. Inflation has come down substantially, which is putting rate cuts on the horizon. That being said, it seems like inflation rates are potentially stalling out, within sight of the goal, not at an area where central banks are going we need to contract because we're at 3-4%, depending on the country, depending on the ranges, and 3% is a target level for many countries. Well, in the U.S. we target 2%. So we're not at crazy high inflation, but it's high enough, and we're seeing sort of kind of the peripheral metrics. For example, they look at in the U.S. specifically, we have what's called a dual mandate. You want full employment and stable prices. That we're talking about 2% inflation and then high employment, essentially. Some people talk about 5% unemployment, but that's really too much of a hacky rule of thumb number. It's somewhat of a random number. But what they don't want to see is meaningfully increasing employment, a weak labor market. They want a strong labor market. That's part of the mandate, and that's common to central banks around the world. I mean, not quite the mandate structure, but the general concept of healthy, strong, fully employed economy. And we're still seeing that labor market quite strong. In fact, probably mention a little bit about how that's affecting Pro AV, how that's affecting services. But for now, we've just seen in the past couple months, just a little bit more stubbornness in inflation than we would like. After I would say 2023, it was inflation really came down in a really lovely way, what everyone wanted. No recession, meaningful decline in inflation, great news. So what that means for interest rates is central banks are not as primed to draw down interest rates as maybe they would have. We're talking about in late 2023. Businesses should be ready for interest rates to stay relatively similar, coming down a little bit probably by the end of the year, but like this qualitatively similar high interest rate environment for the next year, at least. And kind of at least a moderate interest rate environment, not a low interest rate environment for the foreseeable future. To take that to what it means for Pro AV, a little bit more operating expenditures, renovations, repairs, as opposed to those big capital expenditures. Within product categories, a lot of times we see upfront capital costs and operating options sort of like in competition. So do you bring a server into your space, or do you do some cloud server solutions? Do you pay an integrator upfront, full installation, and then dole out money ad hoc for repairs, or do you do like a managed service contract where maybe you don't own the equipment, or you own the equipment but you kind of pay out higher over time? It just moves every kind of option towards just the winds blow towards operating expenditures to the extent that's possible in the interest rate environment. We're not these 80s interest rate environment where it's a huge incentive, but we are in a higher interest rate environment, so it's a stronger push towards operating expenditures.
It would seem that one counterpoint might be corporate profit. So we do see corporate profits certainly have maintained a pretty high level through pandemic and over the last several years, peak levels now. But that is often a case of hedging, right? So they're doing that somewhat because they think there may be a decline in revenue coming forward. They hedge, they sort of stockpile a little bit. The question will become, I guess, the counterpoint to any inflationary or high interest rate issue might be, well, we're sitting on some money. We can invest. We can now grow business because we've got this nest egg of money to put back into the business. But that requires, of course, some certainty, requires a little more certainty around return to office policy, hybrid work modes, growth areas of business, all that kind of stuff. Does that make sense as well?
Absolutely. And I'll say, I'll build on that with 2 points. First point is just stock market. Like sometimes you can't look past it. Stocks are up like 20% since fall. I mean, like they're like talk about S&P 500 here. There's a big long-term increase. S&P 500 is up like 30% in the last year. Let's say your borrowing costs are higher, but now your company's worth 20-30% more. That means you're way less leveraged. So maybe you can get the same interest rate just because you're a safer bet. Because you're that much less leveraged than you would have been at this time last year. So that's a big possibility for capital expenditures. I mean, that's even like, you can issue more stock, like if you want to, like a way to fund, because you just have that money. The second point, you mentioned return to office, confidence. One input that we have right now is kind of the initial phase of our industry outlook and trends analysis report. Now that's just part of the data has been collected. We've processed some of it, not the final numbers. But one thing that stood out to me, some of the survey results feeding into IOTA, is corporate. That vertical market had a lot of skepticism in the 2023 survey. And actually, it was about the most positive one in the 2024 survey. It really stood out to me. A lot of this is a minority of respondents, but a meaningful, like 10-20% were saying like over 10% increase, like big increases that they were anticipating for 2024, and almost no one anticipating decreases, which it was really a strong contrast to 2023, and actually stands out from other vertical markets even in 2024 for how positive it was. Really stood out to me. We'll see, I'll be really curious once kind of the rest of all the data collection and all the modeling gets done, kind of how that nets out for corporate. Interested to track it going forward, on a personal level, on a researcher level. But a lot of positivity there.
For sure. I think a lot of that comes down to, like we've seen overall, a shift perhaps more to software services. And I think conference and collaboration, while there's been some deflationary commoditization issues within that market, where we had a lot of product available, a lot of brands coming into that space because it was the hot place to be active in during the pandemic as companies recovered and adapted. But I think what we're seeing and hearing now is some of that is shorter refresh cycles. So replace the technology that you invested in, maybe early on in the pandemic. They experimented a little bit. They're now ready to put more investment into more, let's call it longer term solutions versus very temporary kind of spur of the moment, adapt to what's happening today. So shorter refresh cycles, I think, a little bit in corporate may be helping us as we go into 2024. The notion of some additional service. You mentioned managed services, remote monitoring. AI plays a role here too, with room optimization, data analytics, all sorts of technologies coming to bear. So, and also some more standardized room concepts. We've been seeing that play out at shows like ISE. I expect at Infocom this year some more of that, where you have models and bundles, ideas, concepts to build around that allow for kind of more rapid rollout, more consistent rollout across the organization. The theme being, of course, emphasis on smaller conference room spaces, huddle rooms, collaboration for 2, 3, 4 instead of 10, 11, 12. The ability to achieve meeting equity by building a technology that allows the in-room to be the away from room, the remote experience to be similar to the in-room experience.
Right.
All that sort of stuff, I think, adds to that story. But absolutely coming through in the early IOTA read is optimism around corporate for sure. I think beyond that, we see some likely suspects, right? Doubling down on anything experience economy. We talked about that at our ISE podcast for sure. Everywhere where there's the potential for investment in bigger, broader, more exciting experiences, those areas of IOTA also seem to be showing additional upside potential for 2024. Any surprises beyond corporate for you that stand out as, say, areas of weakness or strength as we look across markets, solutions, that sort of stuff?
Well, I think one thing I want to call out that was in what you were talking about is that services component. Moving towards operating expenditures, I think that's increasing of services as you kind of paying for a little bit more services, a little bit more managed services, of course. But that's something that came through in kind of the early IOTA data collection is services are a challenge because there's no bench of available AV workers right now. We are very much at that, like we are in the economy at large, full employment for AV. And it's not just kind of, okay, if you're trying to spool up, like increase your staffing, you can't just like go to the unemployed AV worker market and pick the 5 or 10 that you want. Like that market doesn't exist. Not only that, that is competitive for the not huge percent, but some companies that are still hiring. It's also that AV is transitioning. The existing AV workforce doesn't have quite the skill set that would be ideal. A big part of that is, of course, IT skill sets increasingly needed, and AV workers are always learning. It's just part of the industry. This is why certifications exist. People come to these trade shows, professional conferences, etc. They do lots of education. That's just par for the course. But it seems like kind of coming through a little bit, including coming through in the IOTA, that there's as much or more change than ever in terms of the total suite of skills needed. So that means integrators, individual professionals having to invest in their skills, in upskilling, in meeting the challenges of these complex new AV installations. And that has a number of implications for really all segments. For integrators, it's just like the standards are high, they're getting higher. And that's a challenge. How do you keep your workforce competitive especially when we know your margins aren't huge. Like it's not, you can't just throw money at the problem. You have to be precise. For, I would say, manufacturers, the kind of the providers, the talking about what you said, like room templates. Can you find ways to make AV happen with less professional input? The installation's easier. The maintenance is easier. Can you cut those costs? Because integrators are really tight on it. That's a big percent of the total cost of a project, of the maintenance cost. How can you find ways to be more efficient there? As a manufacturer, as a technology provider, as a conferencing platform provider, that's something that I would maybe flag to look out for. And it's certainly nothing that there's an obvious solution coming. We in the future, like we see the economy steadying, hopefully at a nice full employment where it's competitive to hire at all times. Not too competitive. Like we want companies to be able to hire, like okay, but we also don't want a bench of unemployed workers because that's bad. Like we don't want a big bench. We don't want workers unemployed for long periods of time.
Yeah.
And then we have demographics more long term. The projected Pro AV growth, which is still really solid. So there's no obvious solution in the pipeline. So it's how do we do more AV with not too much more work if possible?
Yeah, it would seem that skills differential is an important driver in our market right now because we're hearing from the data that we see, that kind of early read, the channel survey. There's a notion around while technology may become, let's call it more plug and play, ease of use, all those sorts of things, easier to install and configure, the general complexity of its solutions has increased, right? And that's perhaps because there's the complexity around it has to work on the network. It has to be safe and secure. It's got to play well with IT. It has to also solve big challenges like meeting equity and all sorts of other aspects of it. Meanwhile, with strong employment in our market and beyond, wages have gone up, costs of labor have gone up. So what we are hearing actually as a positive for our industry is an increasing margin story. That may be a hard one for our market generally, anecdotally, individually, right? Companies to say, yeah, I'm making more money today than I was before because of so many intrinsic challenges that had existed over the years. During the pandemic, we heard about supply chain issues causing over-ordering in some areas, so lots of inventory costs, sitting on inventory where you waited for that final component before you could bill. But we seem to be coming through that now. Supply chain largely eased. I wouldn't call it fully solved and mitigated. There's still pockets, of course, that we could talk about, but generally eased, improved across the market. So projects can now take place, can continue in a meaningful way. So what it seems to be is that our market's now saying, okay, we've solved some of that. Distributions come in to help alleviate some of the risk and issue. And so now margins are expected to improve from here. That's a good story, right? I think that may be less about a hardware proliferation story and more about a service, installation, configuration. That's the part of the market that we can be a little bit more bullish on as we look at 2024. And that does seem to come through in the data. It's what helps get us to a strong growth from a historical perspective. Let's call it in the 6 to 7% range. Wouldn't be outside of expectation or realism, but I think that's a part of it, right? Is the margin story brought about by an increased complexity of skills required, allowing for competitive differentiation in what can be considered a sort of dense market in a lot of places, a lot of robust competition, but plenty of opportunity, I think, is what we're talking about for the companies involved.
Yeah, I'd say kind of three points jump out at me. One is AI. AI is not big in Pro AV yet. It's big in certain ways, right? Like specific microphone technology, a smart microphone to map the room, to pick up the correct sounds, things like that. But that sort of general purpose AI, not a huge component of Pro AV yet. But where it is, where companies are kind of getting a little bit more involved, you mentioned kind of some of the data analytic type stuff. Those are complex projects. with a potentially very high return, there's it can be a fair bit of margin there. Another point, you mentioned integrators having to hold a fair bit of supply while they wait for that last 10% to come in the last, especially 2022, but including especially the first half of 2023. Now that's easing, so those costs are coming down, and maybe that can be more margin. I would just caution, if you're an integrator expecting to get more money because that issue is now resolved, maybe, I hope so, fingers crossed for you, absolutely, but the forces that dictate your margin are going to be more the overall supply-demand competitive forces. So you're thinking, oh, now my costs are lower, so I'll just keep charging the same and winning the same percentage of projects. Well, the reason you weren't able to boost your costs or your prices even farther to cover those high costs and have really good margins is because you had competition. You still have competition, and they're going to be noticing, wow, supply is easier. I don't have to hold on to, lots of warehousing dead space. So they'll be cutting their, RFP prices. So it's great. I think it'll make your life easier that supply is resolving, but I'm skeptical that that's going to create a margin opportunity for integrators. That said, I'm fully on board. I just mentioned the AI being a potential for margin space. Fully on board as well. Complexity of projects creating that margin as well. And the third thing that I wanted to mention, based off kind of what you were saying, and I'll be curious what stood out to you about this as well, but is distribution.
Yeah.
Now, with easing supply, seems clear that it'll be more difficult for distribution to communicate its value add, right? When an integrator was like, my warehousing is full, like I can't get that last 10% of product. Like, hey, there are companies out there who are the best at this. Like this is what they do. They're billions and billions of dollars of revenue, specializing in getting you what you need, storing it for you, getting it to you on time. So the value add in a supply difficult environment of a distributor is high. Now we are not in that same environment anymore. What is the outlook for the gains that distribution have made? I would say relatively negative. Just from that one aspect, knowing that there's a lot more to the value of distribution than just pure logistics, and so that's something that we've been anxious to see. How is that projecting out into the future? First look from IOTA says actually holding on pretty robustly.
Yes.
Now we're still early days. We haven't had a year where supply was easy. I think that it's going to be 2025, 2026, where it's going to okay, we now had easy supply for a year, for 2 years. Do we really need one more middleman? What is the added value really out of them? But companies are already starting to observe that. We've seen in our data supply issues becoming less and less important. And it seems like distribution is holding up strong. Did that stand out to you?
Definitely.
What was your impression?
Yeah, I'm with you. We've talked about this a lot in previous podcasts and other conversations we've had, just in general about distribution and strengths, weaknesses, opportunities as we go forward. I'm with you that the question is whether or not there's still enough, say, benefit to working through distribution versus, say, your direct relationship with a manufacturer that you may have had an established relationship and or are building a renewed relationship as you come out of the pandemic. I think that the data right now is showing us that lessons learned are not quickly forgotten, right? And so we are still in arguably cone of uncertainty. We talk about that. Lots of uncertainty out there. The fact that there is still questions about, are we in a good economy or a not? Is a negative economy? Is a recession still a possibility as we look at 2024? Those sentiments are still out there. And it reflects, sure, some realities around geopolitics. There's black swans that could still come at us. There are potential supply chain disruptions happening in canals around the world, right? So there are enough things that I think companies have learned. They've shifted kind of operations to work with distribution, can help risk mitigate, deal with uncertainties, help you plan. Add to that the increased complexities of project work. So I'm dealing with product types, hardware types, service types, and software types that I have not dealt with as much before. I'm trying to become more sophisticated with them. And a distribution offers agility, even outside of, say, handling supply chain challenges. There's agility that they offer across product selection, hardware selection, brand selection, etc. that can open up new areas of business for you. So I think all of those things have created some stickiness. At least I agree with you. Short term meaning 3 years. 5 years, it potentially we change again. As some of the brand disruptions that happened during the pandemic that our marketplace is well aware of, start to settle out. Companies that were challenged improve, newcomers have to solidify position, all that sort of stuff. So that kind of shakes itself out. The cone of uncertainty eases, and so it becomes easier for the channel to kind of revert. But reversion is also something we've urged away from, right? This notion that we return entirely to some previous norm just because there has been so much change in the market. So I remain team distribution in this regard, just because to me the fundamentals sort of support the business proposition, the capabilities, the benefits, the possible margin story. I do think a channel margin story for integrator in particular is better when backed by distribution because of the agility and other kind of issues that it can help you with. Knowing that inventory in particular was a huge issue for integrators and suppressed margin as we went through the pandemic. So that makes me a little more sort of long-term optimistic about that kind of part of the market and their ability to maintain a proposition, a value proposition, a position within integration. But certainly, yeah, we'll watch the data. I will admit that I was a bit surprised that in our IOTA survey that we didn't see a little bit more. I'm going back to a direct relationship. We definitely saw, hey, expect that to sort of continue for the time being.
Right. I'm
always leery. Our sample is there's some biases within it, of course. So we always want to make sure we're hearing perspective from more global, different parts of the channel, those sorts of things. So I know you and I will be paying close attention to that as we listen out to the market this year. But for now, it seems to be holding strong.
Yeah, and a lot of times when you do ask those prediction questions, they're kind of like status quo questions.
Yeah,
you just predict. It's great to get the input from hundreds of integrators, right? But some of the these integrators are working on thin margins. They're very much in the day-to-day operations. They're not in order to answer your survey, they're not doing a long-term competitive analysis. They're like, yep, yeah, distribution is still totally working. I think that will continue to work. They're not thinking actually, if we draw the trend lines on supply and we measure out our margin, actually in 2 years' time, it's definitely going to be making more financial sense for saving us 2% on cost to go direct. They're not thinking that, So it's so absolutely. There's still a ton of value in asking those projection questions because it's in the back of the mind on some level, right? But I think that you can't take a difficult question like, hey, what's the long-term trajectory of your use of distribution, and assume that that's going to just be a perfect answer, that those predictions are accurate because these are people who are far too busy to be making a proper in-depth analysis that really if you had all 300 of them do that, that answer would probably be great. But they haven't done that, so it's a little bit more status quo. But we'll see. It's we'll have to monitor that status quo, and again, there is a lot of value in their perspective. So if they think it's similar, that's a signal I take seriously, and and use to adjust my priors.
So all in, let's talk a little bit about then where we land. So 2024, we've kind of talked about macroeconomics, some intrinsic issues, supply chain, other things, factors kind of playing in on the outlook for 2024. What's your over and under? Where would you peg us? So if we're looking at a growth rate based upon all factors that we know of today, what would be your estimate?
Gosh, yeah, you put me on the hot seat with that. I mean, one thing we were talking about even before we got on the call was kind of expected to feel in 2024 like we'd not reversion. You're right, it's not reversion, but kind of achieving that new status quo. We're like, okay, we're in the post-pandemic era. We've been in the post-pandemic era for a little while now. Things are normal. And you go through all the notes, you're like, man, it's still complex out there.
Yes, for sure.
So I feel challenged to try and give you a number. But for 2024, I think it's going to be GDP-wise a relatively low year. I think kind of pro AV-wise in terms of what our industry is able to add, I think I'm optimistic. Putting those two kind of factors together takes me to 5.5 to 6 range. I think a very solid growth level, unspectacular, something that our industry has beaten in many years, will beat again in probably many years, but also comfortably ahead of sort of overall global economic levels. That's where I put us, 5.5 to 6. That's my take. What about you?
Yeah, nice, consistent with our long term. Certainly, just a reminder for audience. Yeah, we tend to be in that 5.5 long term growth average, 5 to 6. It is a difficult question. I respect the kind of the hot seat nature of it because there are a lot of over and unders to consider. The GDP one is a really powerful and compelling one. That globally, we've got economies in recession. We've got others that are they've recovered and are sort of the benefit of that recovery has played out. So we're a bit more in a long-term state of 1-2%, growth rate for GDP. So the upside potential is very real to me. I think, as the year progresses, I think some of the cone of uncertainty starts to alleviate. I'm expecting a better back half than first half, honestly, just because I think that is a steady improvement. So I would probably, in typical fashion, put us more towards a 6. But like you, I would be hard-pressed to go too much beyond that, just because that would be outsized optimism even for someone like myself who's more glass half full. Yes, certainly areas of the market will be well above that. We've talked about venues. We've talked about content production, streaming types of solutions. Those sorts of things have upside. Live events, upside, right? But there's plenty of also downside areas that are a little more challenged out there. So I think a 6. I think a 6 is probably a good, fair estimate for us right now. There'll be companies that will shatter that, and there'll be companies that will see flat to decline, honestly, as we saw in 2023. So that's where I'd put us. So I guess that leaves us with our fun question of the day. So thinking about that notion of experience economy and great AV and all that sort of stuff, the upside potentials for our industry. Tell me about a surprising or compelling AV installation that you've seen lately that was like, wow, that's a vision of future sort of stuff.
Well, this is one that I'm sure a lot of people already know about, but I'm a basketball guy, and seeing the entire AllStar Floor made of LEDs is just it's a wow moment for sure. It's like I didn't realize we were there yet. I remember a number of years ago, I believe it was Pete Putnam saying, essentially the world's going to be paved with LEDs. And I think that, some level of skepticism with that. Like, I think he was a little bit like his timeline, at least. We've missed his timeline. But that came right back to me when it was like, wow, in, the NBA, like, it's not just some like gimmick Harlem Globetrotters, although it is the All-Star game, which is a little bit of a gimmicky game to begin with. But the floor was there, and there wasn't even like, I didn't hear like big complaints about it. From the players, like, this was terrible, like the floor, whatever, was slippery, etc. Like, that was really cool. And I think that just seeing that is a sign of the advances our industry is making, what manufacturers can do, what all of the associated technologists and integrators and so on can create. with advancing technology. That was the big standout to me. What about you?
Yeah, so watching SNL this past week, finally caught up to it. But seeing Ariana Grande's performance on SNL with the virtual production background. So another DV LED story, right? A room paved with DV LED in the background to just enable some really compelling, cool visuals, I think is another example of some of the cutting edge areas of our industry, a great opportunity, even for enterprise, corporate broadcast sorts of stuff. That was a live event, music venue sort of installation, more broadcasty than our industry normally. But gosh, the potential's there, right? That has direct impact to live events business, performance entertainment business, is kind of that example of cutting edge, immersive, experiential. So 100% with you.
And I remember that being one of the coolest things I saw at Infocom last year. Definitely out on the show floor. Like, if you haven't been in that space, like, please, like, get yourself to Infocom or your next major AV trade show where you can check that out, because that technology is cool. It's the booths are usually set up a really cool interactive way for you to take part, even as someone just walking up to. So just something I'll flag for folks. If you haven't been a part, check it out.
Definitely. Good plug for Infocom 2024. Mouthful. Thank you very much for joining us on this Xceptional Insights podcast. Join us next time as we explore yet more compelling examples of cutting-edge AV. Thanks, and see you soon.